Chris Dykes. This is Royal Financials. Today's topic is going to be Stocks 101, and I'm also going to answer some customers' feedback that I got asked on my Royal Financials page. So the first thing we're going to do is we're going to get straight into stocks, all right? All right, Stocks 101, let's get straight into it. So for example, let's take Verizon. Verizon stock symbol is VZ. That's the stock symbol. This is how you pretty much find anything on the market, right? So let's take Verizon. Let's say a stock is trading for $20. The market price of a stock is $20, right? So let's decide, you say, hey, I think Verizon is going to do well. So you say, I want to buy 200 shares of Verizon, right? 200 shares of Verizon at $20. You know, that's going to end up being $4,000, right? 20 shares times 200, 4,000. So that's $4,000 what you invested in Verizon, right? So let's say time goes on and Verizon stock goes from $20 all the way up to $25, right? So the stock went from $20 to $25. You brought it at $20. So that means you made $5 per share. So that means your $1,000 is now equal to $5,000 because your stock went from $20 to $5. And how we know that? We take 5 and we multiply it times 200. That gives us 1,000. And that has 0 there. That's how we got 1,000. So you start out with $4,000. Your stock went up. You made $1,000. Now your money is worth $5,000. This is market value. Now you don't make any money until you sell it. You sell that stock. Now you have $5,000. You made a $1,000 profit. Now you got to keep contact of this because you got to keep track of this because Uncle Sam is going to want his piece. So be very mindful of that. So you can take it here. Now you have $5,000. And let's say this stock went on up to, it shot on up to $30. So now you made an additional $5. So this is a 30. Make sure you can see that. So it went from $20 to $30. So now you make an additional $1,000, right? Boom. So now your money is worth $6,000. And that is how you make money off a stock. And that's the basis of a stock. Now let's look on the reverse end because the market doesn't always do this. Right? You know? So let's say if the stock went the opposite way. How do people lose money? How do you lose money? So you brought, you have your $4,000 here. You bought the stock for $20 and it sunk down to $15. It's the reverse way. Now you just lost $1,000. Now your money is worth $3,000. Now your money is worth $3,000. You didn't lose money. That's what your money is worth. Because if you sell it, that means you lost $1,000. But you can hold on to it. If it went down to $15, you can hold on to it because it can go down to 15 and then it can shoot up to 25. So it depends. You don't lose this money until you sell it. Once you sell it, you lost it. Now if you sell it for a loss, this here, you can file out your taxes as a capital loss. So you have capital gains and you have capital loss that you can file. Not saying you're going to get all this money back, but you can file it as well as a capital loss. So that's how when the stock goes down, and if it goes down to $10, you lost another $1,000, and now your money is worth $2,000. So this is the risk you take. If the stock goes up, like I showed you earlier, you make money. So let's say, how does dividends work? Dividends are what companies pay to its shareholders, right? It pays its shareholders for investing in them because that $4,000 that you invested, Verizon is going to take this money and is going to use it to hopefully make more money. And when it makes more money, it's going to share it back to the people who invested, right? So you have $4,000. Verizon may say you have 200 shares. Remember, you had 200 shares for $20. $20 price. Put a P here for price. Put an S here for shares. You got 200 shares. So Verizon may say, hey, for every person, we're going to pay 5% dividends, which is maybe equate to, we're going to give you 5 cents per stock. So you have 200 shares. It may pay out every quarter. Some companies pay out every quarter. Some companies pay monthly. Some companies pay semi-annually. Some companies pay annually. You just have to look at the particular stock. So this is how you make money on the stock, just by owning it. So that is $10. You get 5 cents. 5 cents times 200 is $10. So you're going to get $10 every month, right? Not every month, but every quarter. Let's say Verizon paid you every quarter. So the next month, You know, your 4,000 now is going to be 4,010. Then it's going to go to 4,020 and whatnot, right? So you can have these $10. You can say, hey, I want these $10 to go into my account. You take it and you go spend it and buy something. Or if you take these $10 you put in your account, you spend it. Remember, you got to pay taxes on that. So the government's going to want that at the end. Want a piece of that at the end of the year. Usually, most companies are going to give you a form to file with your taxes anyway. So if you take this money, you can put it in an account, or you can say, hey, I want to take this money and reinvest it, right? Boom. So this is when you reinvest it, you get $10 here, then you get $10 here, then you go on and on. Now, another thing that they have is called DRIP, the Dividend Reinvestment Program, right? The Dividend Reinvestment Program, what that means is you're going to say, hey, I have 200 shares of stock, right? I have 200 shares. So with these 200 shares, what I'm going to do is instead of you paying me these $10, take these $10 and buy me more stock. So with these $10, if the stock price is $20, that means you have enough money to buy a half a stock. So now instead of going from 200 stocks, now you have 0.5. The next quarter, now you have 201 stock. And the next quarter, you're going to have 200.5 stock. And the next quarter, you're going to have what? Bam, you learned already. You're going to have 202 shares of the stock, right? So this is how you gain more and more shares. So if the price of the stock does go up, if it does go to $25, you're going to get a bigger bang for your buck, because now that's going to be times 5. That's going to be 1, and it's going to be 40. So this is how you gain your, you get more shares. You can take your dividends and reinvest them to get more shares, or you can take it and you can spend it, or you can take it and do whatever you want to do with it. Have it sit in your account and reinvest it somewhere else. So that is stocks, and this is dividends. Hopefully that helped you guys. All right, guys, that's for Stocks 101. I hope that helped you out a lot. The second thing we're going to go into our feedback that I was asked on my Royal Financials page. Make sure you follow me on my Facebook page, Royal Financials. Check us out. You can see our latest updates, what we're thinking, our thoughts, and also you can. That's a great way to ask us questions. But you also can leave comments below, and we can get to those questions as well. So the first question was asked: with Pandora stock moving so sharply down, do you think it will rebound? Okay, so my personal opinion, yes. Pandora stock, we know from yesterday, took about a 10% hit. Today, it bounced back, I think, by 1 or 2%. Essentially, that was rolled out because of the rollout of the Apple's the operating system 7 that came out. It had iTunes Radio on it. It essentially does the same thing as Pandora. So a lot of people said, wow, is this going to be the end of Pandora and satellite radio? So Pandora essentially took a big hit from that, because Pandora, the only way it makes money is through its subscribers and through ads. So with that coming out, a lot of people, that became of a concern, because everybody that had Apple updated to the iOS 7 operating to Windows, not Windows, but Apple's operating to Windows of 7. I don't know why I keep saying Windows, but operating system 7. And also everybody that has iPhones now have iRadio on their phone. They don't have to go download it. So do I think it will rebound? My answer is yes. I do think it will rebound. I do think that Pandora will find its way in this market, because some people like Pandora for the sure fact. Reviews came out today of the Apple's iTunes Radio, and a lot of people didn't like it for whatever reasons. There's a number of things, but I think Pandora will find its way to survive. This is not the first time Pandora has faced adversity. I remember when Pandora sunk down to $7 after hitting the market. But Pandora seems like it's a company that's going to stick around and find its way through this market. It just has another competitor, and I think it will find its way essentially, as we can see already. It took a sharp hit, but now it seems to be rebounding already within one day. The second question, Obamacare. Obamacare will go into effect in 2014, and most companies are preparing for the worst and are threatening layoffs. Where do you see the market heading, and how should the investor position himself to profit the inevitable fluctuation that arises when a law goes into effect? So, great question. Obamacare is around the corner. A lot of companies don't like it, and a lot of companies are preparing themselves for this to go into effect. So how does an investor position himself? An investor can position himself two ways that I can think of, that I know of. First of all, like I discussed earlier in the video, I discussed dividends. You can essentially put your stock in dividend earning stocks. Things like Verizon, PSEC. There's a couple of companies out there. AT&T gives a little bit of dividends, 5%, 2%. Some companies go to 10 or 11%. You can find some companies that you can invest in, and you can hide within your dividends, and you can keep your dividends rolling. You're going to get paid regardless of that stock goes up or if it goes down, as long as those dividends roll in. That's one way you can hide your investments and still make money through the market that way. The second thing is, if companies are preparing to do massive layoffs, things like that, that usually affects a company's stock. When those things hit the media, usually investors think something's going wrong with the company, they're losing profits or something like that, and it usually causes a sharp sell-off. You can do things called puts. Like I discussed in one of my earliest videos I discussed options one-on-one. And you can put puts and you can make money as the stock goes down. So if you know a company that's doing a massive layoff, you can put in an investor to position himself to make money as that company tumbles down. For example, JCPenney, or other ways you can do it. If you think the market is going to do a big crash, right now we have the budget crisis that's coming up where the government shut down. It may affect the market. You can position yourself to put puts on the market to make money as the market goes down. So hopefully that answers your question. So 2 ways an investor can stay alive and make money and stay afloat through this tough times that you can see in the economy. You can place puts if you think a company is going to go down. They're doing massive layoffs. And also you can put your money into dividend-bearing companies and stocks. So those are 2 ways you can still make money through the tough times and the fluctuation of the economy, essentially. So thank you guys for asking. Keep the questions coming. Visit my Facebook page, Royal Financials, and also stay tuned to my YouTube page. Like it, share it, comment, and make sure you hit the subscribe button below. And stay tuned. Thank you.